Hello, everyone. Thank you so much for joining us today. I'm Margaret Sargent, Senior Marketing Associate, and I am joined today by our President and CEO, Dr. Richard Michaud, and Chief Investment Officer, Robert Michaud. The agenda for today's call includes a discussion of the recent trades of our standard and tax-sensitive portfolios, a discussion of the volatility we are currently experiencing, and of course, we will be happy to answer any of your questions during the Q&A session at the end of the call. I would like to make a special note that our investment team is the same team that guided our portfolios through their 15-year history, including the tumultuous markets of 2008-2009. And as an extension of our commitment to stewardship, particularly during this unusual time, we want institutional investors and investment advisors to have transparency into the performance of our risk-targeted strategies. To this end, we encourage you to follow our real-time global optimized ETF indices on S&P, Yahoo Finance, Bloomberg, or your smartphone or other device. The 6 indices, calculated by S&P Dow Jones, track 6 different risk targets along the efficient frontier, ranging from 2080 stock bonds to all equity. Each index uses the same ETFs and investment process as your new frontier portfolios. Just as a quick housekeeping note before we continue, your lines will be muted for the duration of the call to reduce background noise. So if you do have questions, please submit those using the chat feature of GoToWebinar. We will answer as many as we have time for during the Q&A session at the end. So without further ado, I will pass things over to Robert.
All right, so this is an unusual time for all of us. This is our first webinar from our homes, and thank you for your patience during this time. And so it's a challenging time as investors. It's a challenging time for you, I'm sure. And we wanted to provide this opportunity to share our thoughts with you and explain some of the thinking behind what's going on from our perspective, how we think about the markets, and how we think about managing these portfolios going forward and through this. So I wanted to start with maybe just sort of looking back, how I was thinking about investing sort of before this happened, and then continue on through how it's evolved for now. So this is something that I always like to think about, which is that there's different markets behave differently during different volatility regimes. And when markets are calm, they have their calm style returns, low volatility, and low volatility going forward, right? Low volatility tends to beget more lower volatility, and high volatility tends to beget more higher volatility. And the point of this is that the relationship between risk and return that you sort of come to expect from classical finance and economics does generally hold through different volatility regimes. You find that the highest volatility regimes actually do have the greatest future volatility, of course, but they also tend to have a little more return going forward. And that's one of the reasons why investors should generally think about, well, what are your choices following a volatility event? And I summarize those in this type of a chart where you think about, okay, so the event has happened, something unexpected happened, volatility spikes, how should you react to that? And what some people might do is pull out of the market for a little while, for a medium time or a longer time. I see this with 5-day, 1 month, and 3 month sort of periods for being out of the market, and then thought about, well, what types of returns would you be giving up if you pulled out of the market for those periods? And what you see is that the longer you're out, and generally the higher the volatility spike was, the more you're giving up. But remembering that volatility begets future volatility, actually volatility, the one thing it really is predictive of is future volatility. This is likely to be a bumpy, uncomfortable ride, even though you do ultimately, on average, are rewarded for staying invested after some sort of a volatility spike or a crisis. So that's some of the past thinking. And what about this one? Well, this is a true surprise in that it was volatility at the beginning of the year was definitely not anticipating a virus. and then it comes, and then we have historically high volatility. And so just to put this in a context, we've had volatility going over 80. Just trying to put that into one perspective from one one way of thinking about it. As volatility approaches 100, this is sort of the annualized standard deviation or the implied standard deviation of what the futures contracts are saying. And this is, as you get closer to 100, this is saying essentially all of the value of the S&P 500 is being called into question on an annualized basis, whatever that means. But it means it's a lot of volatility, a lot of uncertainty. And and it's not just volatility in the equity markets. We also, unlike 2008, unlike pretty much all previous crises, there's also a lot of uncertainty going on in the fixed income markets. And so what I thought I would do is give sort of 1 week snapshots to show just how rapidly the world is changing. This orange curve is a strongly inverted yield curve from the second of the month. Then we have the gray curve, which is still inverted, but much flatter and much lower. And then we have last week's curve, which actually was upward sloping for the first time. And then and actually crisscrossed, where long rates were higher than they had been the week before, but short rates were lower. And then there's more of that going on, where you're getting rates more on the long end and pulled down more on the short end. And so this is not the sort of thing you expect to see going from to another. So this is one of the reasons you see so much volatility in markets these days. So having been through 2008, what does this mean for an ETF investor? Well, in 2008, equity ETFs didn't have any issues, and they had strong liquidity throughout, and so we would predict that that would continue now, and it has. Now, fixed income ETFs in 2008, I think we really started to learn what it meant. And back then, they had good liquidity, but what people noticed was that fixed income ETFs often deviated from their NAV. And so the NAV is the net asset value, which is something that ETFs is calculated on a regular basis throughout the day. But basically what it is you have you have a service that will price the underlying bonds of the ETF, say what they think the price is, and then of course, and that's what some people might call the fair price or the net value of the ETF. And then of course there's the market price. And these two things are usually very close, but during times of stress in 2008, we saw for the first time really that they were quite different. ETFs were new back then, and especially fixed income ETFs, and so people were wondering what was going on. And there were some arguments that this is a good indication that fixed income ETFs were not doing what they were supposed to be and had some structural flaw. Now, what we learned back then was actually fixed income ETFs were providing an insight into what was going on, and it's the bonds themselves that were not being priced, and no one had any idea what was going on. So for the first time, we were getting real-time information and just how volatile the bond market is. If you own a bond, for some people it's comforting that it just sits there and you have no idea what its real value is. But for investors who actually do care about value, then you really have to look at something like the ETF price to see what the bond is actually worth from day to day and from minute to minute. And so that's what fixed income ETFs were figured out to do. And so then they were seen as a big success. And then another 10 or 12 years went by without anyone talking about the NAV of fixed income ETFs until just recently. And so I think it's good to remember this lesson from 2008, that fixed income ETFs are actually telling us what the underlying value is really of these bonds that aren't getting traded. And the longer the duration, the higher the credit risk, the more unusual the bond, the less liquid they tend to be, And so you're hearing most about the deviations with things like municipal bonds, high yield bonds, corporate bonds to a lesser extent, treasury bonds not at all, and then things like high yield municipal bonds are again sort of combining two of the characteristics that are making their NAV deviate. So, and then, I just maybe wanted to remind you, so some of our qualifications for this, we've been an all ETF strategy since inception. We were really interested in ETFs since before 2004 when we got started. We're really we are the longest tenured ETF investment managers. Dick and I are you will not be able to talk to two people who have been, or even one person who's been investing in ETFs longer than we have. So it is our main focus, and we do put a lot. This is what we do, and we put a lot of thought into it. As portfolios and build portfolios of ETFs. So in this crisis, or in any crisis, what's the choice for an investor, for your clients? And they can reduce their risk, they can sell out, they can panic, they can stay invested, which is hopefully what most people should be doing during a time like this, or they can view this as a buying opportunity and buy more. Hopefully, the middle choice is the one that most investors will make if they're in a investment strategy that really fits their investment goals. Now, what are our choices as an asset manager? And these are different. It's a different perspective. And so you can think about doing nothing, which is what a lot of long-term managers do. They just buy the market portfolio and they basically never rebalance, or rebalance once a year. What some other people think about doing is tactically timing the markets, and there are cases to be made where things will get much worse and you should de-risk, or things will get, or this is a great opportunity and some people are buying. That's not what we're about either. We're about trying to be thoughtful investors that stick to our principles and try to, and so what does that really mean? So what are the components? So we think about up-to-date risk and return expectations. So the market is changing rapidly. You saw the yield curves, credit spreads are changing. The risk relationships between China and the US, these are dramatically changing. And you need to take that into account in the portfolio that you have today. So of course, portfolio efficiency, trying to maximize return, minimize risk across all the risk levels is important, and because this is some way that you can continue to add investor value in all market environments. And then maintain the diversification of your portfolio is important. And risk management, have a transparent risk management process, not let your portfolio drift too far from its objectives is an important thing to do as well. And we do this not just through portfolio optimization, but also through our statistical rebalancing test. And the test is designed to help us, when it is and statistically meaningful, to an expectation to improve the outcome for investors. And so this is why we rebalanced in this case, is our statistical test was saying, giving extraordinarily high, strong signals for how to rebalance. Now that we should rebalance, that it would benefit the investors to rebalance. Now we had to not just blindly follow a statistical test, we had to put this into context of what's going on here, the very high levels of volatility. And the fact that we actually, markets weren't functioning properly during some of this time, and so we did not want to just invest on any day. We wanted to hold on to keep on top of markets and make sure that we're investing at a time where not only it would be a meaningful change, but a time where it is not so volatile that we don't know what prices we're going to get when we do trade. And so what we have had to do is we've had to follow markets very closely. Fortunately, our technology allows us to trade fairly rapidly once we realize that conditions are sufficient to rebalance the portfolio. We monitored the volatility and liquidity of each of our ETFs that we invest in. And then we found a couple of windows during this time period, last Friday, for instance, where we thought it would be beneficial to trade the portfolios. This doesn't mean that we think that now markets are going to go up. We do not have any directional forecasts about markets, but we think that this is a time where it's a meaningful improvement in based on all these criteria for us to trade the portfolio and rebalance them. So maybe Dick would like to add something here, or we could open it up for questions.
Sure. I'd like to say just a couple words because we do want to leave some time for questions here, and I'm sure in these really crazy times of this is a time period where Frank Knight used to talk about. He had three levels of uncertainty associated with a roulette wheel. You don't know what's going to happen, but you know what the probability is. And then an uncertainty associated with statistical estimation, like trying to estimate fire insurance policies or car insurance policies for an insurance company. But his third level had to do with essentially unknowable risk. What we call, and we really care a lot about, is unforecastable risk. It is not a way, you don't have any, there's no formula here. There's no equation here. There's no model here. Who had a model of a coronavirus pandemic that globally affects people around the world? Nobody did. And so when you think in terms of unforecastable risk, it's really outside of any quantitative model, any Pareto model, all of the different things that finance professors love to talk about. But in real investing has to think in terms of unforecastable risk. So the way we optimize a portfolio, as you know, is we use thousands of scenarios and average them before we create a new portfolio. And while that's not perfect, it still is better than just relying on one scenario, which is very imperfect. The other reason for Robert and I being on this webinar is that we heard a lot of things in terms of what is the problem with ETFs, okay? Exchange traded funds is probably one of the most important financial engineering products for almost ever since some derivative products, okay? And by the way, we only use ETFs that are well-defined indices. We're not using very strange indices. These are index funds. And how we invest is we invest in very high quality ETFs, and then we intelligently manage those high quality ETFs. So nothing fancy, no derivatives, no active management of ETFs. And by the way, we pick the ETFs. We don't have some company decide that their ETFs are the best there is. So as an ETF manager, we are independently trying to find ETFs. Now, that doesn't mean we can't find an ETF that doesn't have a discount rate at some point in time in these kinds of high volatility time periods. But what we have found is even in the case of some ETFs that had pretty serious discounts, the discounts disappeared the next day because the arbitrages knew the underlying versus the index, and they knew that the prices would come back directly to it. So the kinds of ETFs we use are the best we can find, and it's not one particular family and one particular company. So that is one of the things that we want to say. And then just fundamentally, as Robert was trying to say, there are three different ways of thinking about it, and a slightly different way of looking at it is that you can cash out. And cashing out does make sense for certain kinds of investors, depending in their time period, whether they're in retirement or whatever the issues are that they have, in particular, the health or whatever. So cashing out is not necessarily crazy at all, okay? but it limits your ability to participate in any change in how the market will perform if you have any kind of long-term investing horizon. And then the second level, of course, is that you hear people, well, stay the course, stay the course. Well, maybe, okay. Staying the course is dependent on some academics' view of capital markets, that they are basically always the same, which I think very, very, very few people on this call think that capital markets are always the same. Okay, most of us think they change every 3 seconds or every 5 minutes. So that's stay the course. Well, maybe it'll come back, but maybe not, or maybe not the same way. And then the third way is what we try to do. And what we try to do is have a portfolio that is optimal along an efficient frontier that has to do with systematic risks associated with long-term investing. So systematic risk is reasonably well approximated by a stock-bond ratio. So we have these different levels of stock-bond ratio risk. And then what we try to do is optimize to those stock-bond ratio optimal portfolios. And it's a little bit like when we rebalance our portfolios, which we use the statistical test. It's not an end of the month, end of the week, whatever it is. Clearly, the statistical test is so much better way to think about a rebalancing than any calendar method, any individual security method. It is fundamentally the right way to think about the problem, and we have spent a great deal of time trying to build that rebalancing test. So we rebalance the portfolio when it makes sense to rebalance. Of course, recently, we didn't almost need a rebalancing test to figure out that our portfolios should be rebalanced. So we wanted to rebalance them as soon as we could. But as Robert was saying, is that we wanted to make sure that we weren't trading in a crazy market. And it's not as if we know what a crazy market really is, but we kind of know what a market that isn't the happiest time to trade. So we kept our powder dry. We tried to consider a whole bunch of issues. What's the VIX? What's going on in the economy? What's going on in China, South Korea, Italy? All of the other issues associated with the progress of the pandemic across the world, and what it was affecting U.S. bonds, of course, the Federal Reserve, and a reaction from the Federal Reserve, the administration, of course, and all of the states associated with the general unease about what's going on in the capital markets from our point of view. And so we rebalanced twice last week. It was a tough call, but I think what we're trying to do is make sure that if you can think about what you're managing, sailing a yacht or sailing a large sailing boat, whatever, but you're trying to make sure that the portfolio, the ship is really well balanced with respect to wind coming from any possible direction, the so-called unforecastable risk that we're trying to deal with, and to keep the ship on an even keel. And so what we do is optimize at each point in time with the rebalancing wheel to an optimal portfolio, so that each one of the portfolios that we have optimal with respect to managing the risk as we best can estimate it. And finally, for us, we can't really recommend that you get out of the market, because that really does depend on a whole lot of individual things. And I'm not sure that's really a good solution at all. And staying the course, we're not crazy about that either, because it's just assuming too many things that could be true that might not be true. But what we're trying to do is rebalance the portfolios to optimality. But maybe because of so much risk, okay? As you know what the Federal Reserve did today, they went all in, and unbelievable, intelligent managing of the Federal Reserve that had to do with the experiences and the lessons learned in 2008, 2009. But right now, we need a fiscal stimulus as well. The central banks, 31 central banks, were all in coordination recently. So what is going on with central banks is about all we can expect. And what we need is a good fiscal stimulus program. Right now, the markets were up for a while based on the Federal Reserve's response, and then they went down because of the wrangling in going on in Washington. Right now, we will get a $2 trillion stimulus package. And when we do, I think the markets are going to respond reasonably positively. I'm not forecasting, but I think so. Okay, I think what's going on right now is the market closed, disappointed that the Washington politicians couldn't get together and get a decent bill. So anyway, that's all what I wanted to say. The one last thing I wanted to say is since we don't do crazy ETFs here, we do the plain vanilla, best quality I think anybody can find. But the other thing to say is that for anybody who is in a target date fund, I think this time period has really shown the wisdom of target risk funds versus target date funds. In a target risk world, what you can do is just slide down the efficient frontier to take less risk depending on how you feel about the overall capital market environment. And that, to us, is what we suggested back in 2008 and 2009. Slide down the efficient frontier if you want to take less risk during this time period. But in a target date fund, you can't do anything. You have to wait until whenever, 2030, 2040 to change the portfolio. I don't think that's a very good idea. Target risk funds are actually the best way to think about long-term investing. And so, Margaret, maybe we can have people ask questions for Robert and I.
Absolutely, yeah. Thank you both so much. And so the first question that I'm seeing, maybe Robert, you can field this one. Were any new ETFs introduced into the portfolios as part of the rebalance?
No, we wanted to stick with a standard set of ETFs that we're extremely familiar with, that we're extremely comfortable with liquidity. We do have sort of a watch list of interesting new ETFs that we are consider adding to the portfolio, and there might have been one of those in the queue, so to speak. But during a time like this, you want to be prudent, you want to be conservative for all of your choices, and so we did not want to introduce any new ETFs into the portfolios.
It looks like we have one more question that's come in. Let's see. All right, so we have two more questions. So let's do those two, and then I think we might have to wrap for time's sake. So we have, did the asset allocation change in conjunction with the most recent rebalance?
So there's two components of any rebalance, and one is how much of it is coming from price changes of the individual ETFs, and the other part is how much of it is coming from new structural information about the risk and return relationship, the updated risk and return relationship of all of the asset classes. And so this certainly had a lot of both of those things going on. So this would not be if you're used to a certain strategic manager who has had the same model for the last decade, this is not that situation. So this is not merely rebalancing back to last year's model. If it had been just rebalancing back to last year's model, then we might not have done the trade. But what really made the trade important, the rebalance important, was the risk and return characteristics of all of the asset classes globally has really changed dramatically in the last month or so. And so we needed to change the model as well. We needed to adjust the model for different correlation relationships, different risks of individual asset classes that we now understand to be more risky, and we may expect to be more risky going forward. And some that you can think of China as a country that had a lot more volatility than any other equity market, and now maybe doesn't, because they're affected by this risk in a different way than we are.
And just to add to what Robert had to say is that the portfolios needed to be rebalanced with respect to the risk return, the stock bond ratio. So we had a lot more. We needed to a lot more bonds than we needed to rebalance, but also the rebalancing had to do with both the equity side as well as the fixed income side. And so that was the interesting part of the rebalancing process, and how we saw that the optimized portfolios needed to be rebalanced in terms of the inherent correlations associated with equities on the one hand side and fixed income securities on the other side.
It seems like a lot of people would love to hear a little bit more about details around the rebalance itself, the details of the rebalance, what the changes to the portfolios looked like. Were there changes in credit and duration? Can we talk about kind of the shifts that we were seeing there?
Changes in credit, lower, less credit, more duration. More government bonds, for example, because of the issues of risk and so on, and more defensiveness on the equity side, for example. I think these portfolios. I think maybe Robert should take this question a little bit further.
Sure, I can. I'd like to be able to give a really simple answer, but unfortunately, it's a little bit complex because it has to do with it's different answer for a conservative portfolio versus an aggressive portfolio, and there are things going on within the stock and the bond components individually. And as you know, we optimize the whole portfolio together. So the 2080 portfolio is designed to have not just more bonds, but actually be a more conservative portfolio. So there you will see maybe a shift towards domestic away from international. You'll also, where the one surprising exception there is China, is for the first time there's a small allocation to China in a conservative portfolio. It's a very small allocation. But this is actually helping diversify the portfolio during a time like this. The biggest changes that are the most obvious, I think, are on the fixed income side because of the decline of yields and the increase in credit spreads. And so what you will see is that there's, on the fixed income side, since the credit spreads are so high, that the optimization process will want to take a little bit more credit risk and try to take a little bit less equity risk, which is highly correlated to it.
Okay, so with regards to taxes, how do you consider tax impacts in rebalancing or trading decisions?
Taxes are a big consideration obviously in the tax-sensitive portfolios. So normally we would be very careful about making a rebalance to our tax-sensitive portfolios only a month and a half after we had rebalanced them earlier because of the risk of short-term gains. Now, in this case, we were able to make sure that our trades did not incur any meaningful short-term gains, and that those would be more than offset by short-term losses in a portfolio. I think also from the perspective of taxable investors, you never like it when the portfolio goes down, but there will at least be some likely tax losses that would be part of this trade as well. And so that made it a lot more palatable to us to be able to do a rebalance so shortly after the previous tax-sensitive rebalance, which in hindsight the previous rebalance had very good timing because it was pretty close to the market high before the crisis started.
Okay, thank you, Robert. So I believe this next question is a multi-part question. So I will pass these over to you. So one, do you change targets for rebalancing, or are they kept similar? Two would be, how do you determine rebalancing to optimality in a time of unforecastable risk? And then do you have any input on prior pandemics and effects on markets?
Well, we optimize directly to the risk of stock bond ratios that we maintain. So we're always going back to 20/80, 40/60, 60/40, whatever it is, okay? And that the point is that that's the kind of manager we are. We're trying to build optimal portfolios relative to long-term systematic risk objectives. And so for anybody who's taking into account their long-term liabilities and so on, I think that evidence there's not much evidence in finance that really is very reliable. But the one thing I find that's really pretty reliable, it has to do with the stock bond ratio in terms of a good measure of long-term systematic. And so you can use the stock bond ratio to go slide up the curve if you had a time period for which risk seems to be a better thing to take. And on the other hand, in these time periods where there's an awful lot of uncertainty, including unforecastable risk, for sure, maybe a little bit less unforecastable at this point, but it doesn't look like it's a good thing to forecast. Nevertheless, it is a way for people to reduce risk without reducing optimality of the portfolios that they are investing in. So that is what we are trying to do. And the other thing to say is that if the boat is being sailed into a storm, things about the boat need to be changed in terms of ballast and sails and that kind of thing that need to be maintained to have the ship actually sail as well as possible. And in the world of investing, you have new data, new relationships, like Robert was saying about China and other things. That it's not the only example, but we see relationships that are being estimated with the covariance matrix, and the data does show some changes. And of course, we have new data to plug in, including with the fact that we have interest rates that are almost beyond imagining not so very long ago. So we have new data to use to manage the portfolios. And I don't know if I have anything great wisdom to say about unforecastable risk beyond the fact that we do everything we can with an optimization process that has been patented and that has been, I think, tested by many people. It's the only one with a simulation test of out-of-sample performance that is better than the Markowitz solution. And I don't think Harry Markowitz has ever said anything better about anybody besides us that way. So we do what we can with the information that we have, and we try to be very, very conservative about not misusing information. But there is new information. There is a lot of new information, and the portfolios are designed to reflect that. Did you want to add anything, Robert?
Yes. So just in case there was any lack of clarity, we may be rebalancing the portfolio back to the risk targets, but the allocations within those stocks and bonds across all asset classes have been updated and are different than they were before. It's not just price movements, it's also new information resulting in new models that we anticipate to be more efficient going forward in this market environment. As far as unforecastable risks go, by their nature, there's not too much you can do about it other than be well diversified, be diversified in every sense of that. So don't have concentration to individual stocks, don't have concentration to individual geographic regions. This is an example of some time where there might be a risk in one geographical region that we cannot possibly forecast given the way the world evolves. And as a little bit of an optimist here is as long as the global economy eventually recovers, a globally diversified portfolio will be able to maintain and ultimately benefit for the investors.
So I do have one point that I always say, actually, and sometimes I forget what I usually always say, but the single most important and most effective risk management strategy is effective diversification. It is essentially the only risk management strategy that is useful for unforecastable risk. And that just makes sense. So if you have truly effective diversification, it's going to be whatever is best. It'll do whatever is best with the information that is available at that point in time to deal with the new information. And so that is what our goal is truly effective diversification for all different levels of systematic risk.
Thank you, guys. The next question, Robert, if you want to take this, were there any major differences to the tax-sensitive rebalance versus the non-tax sensitive portfolios?
The tax-sensitive rebalance, we did have to be more careful about the individual securities that were the individual ETFs, what their prices were at the time that they were changing. We had to give consideration to the sort of range of points at which investors would have bought into those models, and tried to make sure that any gains would either be long-term gains or short-term losses. And so, there's no way we can control the timing of every individual investor's cash flows, but we did look across a wide range of sort of entry points to the portfolios to make sure that virtually all investors in the portfolio would have a good tax experience. I think also the turnover might be a little bit lower for the tax-sensitive portfolios, partially as a result of this.
Great. And then one final question that I have from our audience. What are you currently doing about the massive discrepancies between market price and NAVs?
So this is one of the topics I started with early on, and it is my opinion that one of the best things that 2008 gave us is that we got to understand that often a discrepancy between market price and NAV is not a problem with the ETF, but rather a problem with the underlying bond market, and that the ETF is giving us insight into what's going on with these often illiquid bonds. That said, ETFs are not perfect, for sure. Nothing is. And so there are cases where the underlying bonds are not liquid at all, and then the market makers are not able to sufficiently hedge the ETFs with anything liquid themselves. And so there's nothing, you can't create something from nothing in this case. You can't create liquidity and accuracy when there is nothing underneath the bonds that has that. And so I think there have been some cases of dislocation where, and you can actually see this, where one bond ETF with a very similar index is kind of lagging another bond ETF. Maybe the more liquid one is doing something, and then the next day the price catches up on the less liquid ETF itself. So this is a very trying time for especially fixed income ETFs because the past hedges, I think one of the things is the past hedges that the market makers would use that had been very effective for years haven't been sufficient. When you're, I hear one of the things they try to do is they try to use different treasuries to try to provide a liquid way to hedge many of these corporate or municipal bond ETFs, and those have worked well in the past, have not worked at all well recently. So what we do is we pay careful attention to make sure that when we're trading, one thing is that we're often trying to trade like for like. So if we're trading one municipal bond ETF for another municipal bond ETF of a slightly different duration, then we can be more confident, and then we do it at the same time, then we can be more confident that the trade is likely to be of sort of net even for the investor, whether NAVs are high or NAVs are low, or NAVs are very low, as they have been some of these times, that the investor will be getting a similar experience on both sides of the trade so that they won't be adversely impacted. I have a little graph. I'm not sure if it will be helpful, but this is an example of trying to, looking at the worst of them in the recent weeks, which is high yield municipal bonds. So municipal bonds have had some trouble, and in terms of, I wouldn't call it trouble, but they've been less liquid, they've been harder to hedge, and they have deviated more from their NAV. And also high yield bonds as well. And so this is the one that has had the largest discounts, sometimes double-digit discounts below its NAV. And then just compare how it's trading versus the S&P. And so we know that S&P ETFs have not had any problem during this time. And what you see is that they're both incredibly volatile, but they both keep trading. And one thing that you would see if there were real problems is that their price would shoot up on a buy, shoot down on a sell, and do things like that. But we see is that actually trades in size are executing at what the market seems to indicate is the fair price, the reasonable market price for these ETFs. And so if there is a agreed upon market price for an ETF, that there are parties in both directions willing to trade a reasonable amount of, then I would claim as a financial economist that that is the right price for those securities, and the NAV is not correct.
Great, thank you, Robert. We are at the end of the hour, so that is all that we have time for today. Thank you both so much, Robert and Richard. We really appreciate your input. To anyone who has any further questions, please feel free to reach out to the team. We will be happy to field those. I also encourage all of you to take advantage of Frontier Advisor, our one-stop advisor resource center. Any notes that you've seen come recently from the investment committee, it will be available as blogs on Frontier Advisor. You can download those. And you can also find up-to-date portfolio analytics for all of our portfolios, as well as helpful marketing materials that you can download and have. Thank you again so much for joining us, everyone, and we will see you on the next webinar.
Thank you.
Thank you.
Be well.